early. I know that there was some traffic out there, so thank you for coming here on time. So our first panel, I'm very excited to introduce you to. It's a venture capital, and we're looking at shifting paradigms, opportunities, and challenges. And it is my pleasure to introduce our moderator, Sajjad Masood, who is the co-founder and the co-president at Harvard Angels. He's been a great friend and a mentor to the Halt Venture Group. So with that, let's leave it to our panel.
Can you hear me? Okay. Right, it's a pleasure to be here, and it's a really great panel that the group has put together. And I was looking at everybody's profile, and you know, it's perfect in the sense that it really covers the entire broad spectrum of the investing space out there in the Silicon Valley and the tech space in general. So I think it's going to be a really interesting discussion, and we're probably going to touch on many different opportunities and challenges that we're seeing out there as you know, different rules and paradigms are shifting. So let me just start over by asking our panelists to tell us a little bit about what they're doing and what their firms are doing, what they're focused on, and how they think they're really contributing to the ecosystem out there. Let me start with Rebecca.
Thank you.
Yeah.
So my name is Rebecca Lynn. I'm with Morgan Thaler Ventures. Morgan Thaler's been around for about 40 years. We do early stage healthcare and IT. We focus on early stage. Early stage to us means seed, so literally a couple people and an idea. Series A and even some Series B. And historically, we've actually done about 20% seed, but I think the definitions are definitely changing at this point in time. So for us, seed has always meant investing in more of an EIR kind of philosophy, with a couple people working on an idea over some time that we really work with them and help them to see that through. So in terms of what I look for, I do mobile and financial services and healthcare IT. And healthcare IT more from the consumer perspective, because I believe no one cares more about your health than you personally. And so my investments include Lending Club and Practice Fusion. I'm also on the board of Socrata, and other investments you might have heard of in our firm are Evernote and Siri. So that's a little bit about me.
Great, Dave.
So I guess what I've been doing lately, or what our fund strategy is, I guess.
Yeah, so if you could talk a little bit about the fund strategy, how you think you're playing an important role in the ecosystem out there. You know,
I'm not playing an important role at all. Maybe my checks are. So we have a pretty different strategy from most other folks. I guess I started out as a geek and a programmer, was a small-time but crappy entrepreneur, had a very small exit, did a few years at PayPal doing geek marketing, and started angel investing when I left in 2004. Was an investor in Mint.com, which is probably my notable exit today, acquired by Intuit a few years ago for $170 million. So I've done a lot of investment on a very small budget. Worked for Founders Fund, which was started by some ex-PayPal and Facebook folks, and kind of piloted a model there through an internal angel fund and through the Facebook Incubator Fund, where we did about 43 investments in a period of 15 months, less than $3 million, so really high pace, small check size, expected high failure rate. So probably of those 43 investments, I would say at least 7, maybe up to 10 or 12 are likely to have some material outcome, most notably probably Twilio and Wildfire, but several others as well, SendGrid and Bitly, and a few more. But that approach kind of became the foundation for what we are trying to do with 500 Startups. That's our new fund that was started last summer. And we're, so I'll just go right at it. We are spray and pray investing for people who don't like that term. And for those who might have a more formed analysis, we are quantitative, high volume, diversified investing. And what that means is we intend to do about 100 investments a year, probably 200 out of the first fund at incubation and seed, probably in the $50,000 to $100,000 check size, valuation between $1 to $5 million, hopefully not more than that. Out of those 200, we expect maybe 50 to approach or get to a Series A equivalent, and maybe 25 to a Series B equivalent. Hopefully 10 to 20 material exits that might be between, let's say, 50 to 250 million. And we would call that singles and doubles hitting. So if Sequoia is the Yankees, we're the Oakland A's. If Benchmark is Barry Bonds, we're trying to be Ichiro. Which is, we want to do a lot of technical hitting, make sure we get on first base, steal second consistently. And every once in a while, we'll hit a screamer line drive over the fence. Did you get all that? Sorry, that's a little weird. All right. We've done 107 investments to date since last summer.
Okay, so we're in a very different part of the food chain, but when companies grow up and they've stopped using open source software and all kinds of good free stuff and they have to hire salespeople, usually that takes capital. So we're a mid and later stage fund. A typical investment for us is a company that's doing maybe a handful of millions in revenue, coming off a year where they've tripled in revenue and are on their way to another 2.5 or 3 times the revenue. So we're looking for big markets and the leading company in the market and trying to get that very high growth.
Everyone here in the back.
Yeah? Okay.
Better.
Is the mic on now? Okay.
There we go.
Okay. Oh, never mind. We're okay. No, let's not talk time. Anyway, so we have big practice in software as a service. We're a large investor in Omniture, FrontBridge, ExactTarget, a whole bunch of other really great software as a service companies, and a couple of big mobile game companies. I'm on the board of the biggest premium health content company. It's called Everyday Health. So, and we do also traditional infrastructure tech, and about a third of our capital goes into healthcare. I've been with the fund, Scale Venture Partners, for about 10 years, and before that spent about 10 years tech marketing exec, mostly at Adobe Systems, then a couple of startups in the bubble, and then a past life as a consultant at Bain Company.
I'm Rudy Garza, and I actually should have sat right in between you guys, because that's kind of where we fit. We're a $500,000 super angel investor out of Austin, Texas. We're probably the only Texas person you'll see out in California on a regular basis, or on the East Coast as well. 60% of our investments will be in Texas, 40% will be anywhere in the domestic U.S. We usually come in when there's 2 to 4 entrepreneurs. They have a beta product that's up and running, that's in a pretty exciting market. I started the firm in '97. Was fortunate enough to, on my second investment, seed investment, Kleiner Perkins came in and syndicated with us, and then from there, Polaris came in and did the next one, and then Bain Capital, and then, you know, it just kind of kept rolling along. Current syndication partners with us are Maples or Floodgate out here, IVP, NEA. So we tend to grab the companies sort of maybe post-Dave, get them running fast enough to where, you know, the big, yeah, right, the bigger funds want to get involved, and then we, you know, rock and roll. So we're pretty opportunistic. Hardware, software, web services, internet, consumer. We're just starting to look at some apps. We closed on $10 million in December. This is our 4th fund, and you know, we're real excited about the landscape. We will look at some clean tech, but clean tech at the edges that's real lightweight. So that's G51.
Great. Thank you for these introductions. You know, starting with Sharon, I guess we've got everything covered, all the way from downstream investing to upstream at 500 startups, where Dave is getting involved with very, very early stage companies and writing seed investment checks. So let me jump into some of the shifting paradigms, or at least perceptions that have been out there. You know, there's been a lot of talk about the VC industry is changing. There's a lot of change out there. Are all the large traditional VC firms that have been out there for a long time, they've been raising large size funds and giving out lots of money to early stage companies, are they still being able to operate the way they were operating a few years ago? How has that changed, and how does it affect what you're doing or what your firm is doing. So, for example, in your case, Rebecca, you're working with a firm that's been a traditional VC for a very, very long time, 40 plus years, made lots of investments, 300 plus investments. Has anything changed in terms of your philosophy? And if you look at the new paradigms out there, there are lots of upstream activity out there. How does it affect what you do on a day-to-day basis? And I'd like to get everyone's input on how they feel they're doing something that's because of what's changed in the larger context out there.
Can you start?
Yeah.
So, I mean, things have changed. It depends what time frame you look at, right? If we look at things in the last 5 years, things have changed a lot. If you look at things in the context of since the 80s, things actually haven't changed that much. Actually, there's a big argument to say that we're back to sort of normality in a lot of ways. So prior to the last bubble, firms were smaller. Series A investment was 3 to 5 million. That's what you needed to get a company going. And it's come down a lot now in terms of money because of cloud computing and things like that. But outside of that pocket of investing, it's still 3 to 5 million for the most part. So I think what happened is we're going back to smaller fund sizes. We had $400 million funds. That used to be our fund size, pre the last couple of funds. And then all of a sudden you started getting these mega funds of 800 million, a billion plus. And we're seeing large firms like Menlo scale back from $1 billion fund back to a $400 million fund, which is where the LPs have seen success in the past. So things are changing, but I think if you look at it on a more grand scheme, they're shifting back to where they were before. I mean, even angels, David Morgenthaler, that's how he started out, and all of the guys in the Valley. I mean, those funds started out with first their personal money, then taking in some money from some friends, and then taking in some LP money and some endowment money and foundation money. So we're seeing that same cycle happen again, which I think is really helpful. And what happened in the fall of '08 created this massive kind of hole in the ground for new people to move into the industry. And I remember in that time period.
Is that why I'm here?
No, it was not. That's why I'm here too, probably, right? In terms of in that time period, we saw in a couple weeks' time, 6 different angel term sheets pulled of his traditional angels, and there was a guy that, and I won't name the name, but one of the more prestigious law firms that got up and said, "Angel investing's dead. It will never come back. Nobody he knows will ever put money into the angel market again." And so everything was quiet. The VCs were shifting more to Series B, and then it left this whole just unmet need and opportunity in that angel space for us to see new people come on board. So I actually see it more as a regeneration of the venture space than a massive shift.
Right. So before we move on to Dave, I just wanted to just reiterate what you said. I think you mentioned the word cyclical, or that there's a cycle out there. Does that mean that there's we're going to be back to where we were maybe 5-6 years ago at some point in time, or is this change a permanent change?
No. So when everything went down, when Lehman and everything went down, I actually hosted an event for young people in venture capital who hadn't had the benefit of tenure in the business. And I had Reed Dennis and Dick Kramlich of NEA and David Morgenthaler come and talk to us, because everyone was telling us, "Oh my God, why on earth would you join venture capital? The industry is dead, it's never coming back." And they all just added the benefit of their years and having seen quite a bit, right? And they'd laugh and like, "This is the best time to get in. Every 10 years, venture capital is going to go away." And it is a very cyclical industry. So I would say, I don't know where we're at, but if you look, there's this thing called the Zug cycle, and it's every 7 to 8 years, you kind of, you get this nice cyclical phenomenon. I still think we're on the way up, but I don't know if we'll ever see 99 again. I lived through that in the company side of the world. I hope we don't, actually, because it was a little insane. But I do think the liquidity window is open. It was slammed shut a couple of years ago, and hopefully we'll see that continue for a while. But I can also tell you that the liquidity window will be shut again. And I don't know exactly the timing, but if you believe history, it'll probably be in the next 5 to 7 years, and then we'll go through the whole process again.